Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Thanks for listening to the show. Got Patrick O'Hare on today in the second segment. First things first, though, this is a headline that just shows you that sometimes you can't make the stuff up and you can never see it coming. Struggling shoe retailer Allbirds makes a bizarre pivot from shoes to AI. The stock is exploding up more than 400% today. The company, valued around $4 billion at its peak, sold its intellectual property and other assets 2 weeks ago for $39 million. The stock surged over 400% today from $3 to $13 just on the news that somehow, some way, some shape, some form, their old shoe business and underwear business, they got into all sorts of stuff that just never really worked, is going to be going after low latency AI compute hardware and provide access under long-term lease arrangements. Okay. Didn't see that one coming. Let's talk about the stock market. A lot of people didn't see this coming. A 10-day rally on the NASDAQ, 9 out of 10-day rally on the S&P 500. The S&P 500 is within points of its all-time high today, up 41 basis points, 0.4%, sitting at 69.96. I believe 7,002 is the all-time high. At this pace, it's going to take it out today because the NASDAQ is chugging up 94 basis points, almost 1%, sitting at 23,861, up 223 points. Russell 2000, a little bit of an underperformer, up only 11 basis points. One Federal Reserve member says that she doesn't see interest rates moving for a long time. And the Russell 2000 tends to rally on that. The Dow Jones Industrial Average down 0.33%, sitting at 48,389. We're pretty deep into earnings season. We're the first weekend where it's a lot of financials. But tonight after the market closes, we do get Netflix. That's going to give us a little insight into streaming and how much time Americans are paying attention. Does it affect Alphabet's, Google's / YouTube's consumption? From what I'm seeing, YouTube is rocking and rolling, and Netflix is slipping a bit as far as eyeballs during the evening. So Bitcoin hitting some other numbers. Opening today, down $1,200 to 74,112. That's down 1.6%. Gold is down less. It's down fractions, almost 15 basis points or 0.25% at 48.42. Crude oil sits at $91.44, basically making no material move today. We've gone from a 10% correction to a 10% rebound in 10 days. The major indices are knocking at the door of all-time highs. The U.S. and Iran are still engaged in trying to renew ceasefire negotiations. According to the Wall Street Journal in this report this morning, they haven't agreed yet on a date or location, but they're talking. Some headlines out there today. JP Morgan Chase reported March credit card metrics. These are important. I've got a couple Chase cards. They reported a March U.S. net credit losses of 1.7% versus 1.6% last month, with 30-plus day delinquencies of 0.9% versus 0.92% last month. Not a lot going on there. Bank of America CEO Brian Moynihan said this morning on a CNBC interview that higher gas prices could cause consumers to think twice about spending on other things. But so far, he's not seeing any of that. All businesses are performing well across the board, he said. The company is increasing net interest income guidance. Consumer delinquencies were down year over year. Spending growth for Bank of America customers was up 5% year over year. Credit card spending was up 6% year over year. But he did end with that cautious tone of higher gas prices could cause consumers to think twice about spending on other things. But so far, he's not seeing it. I find that the banks are the best read on the consumers and credit cards and spending. Spending is a play into what drives our economy, retail, services. What drives our economy ultimately drives profits. The person who's serving you food is making a little bit more money this year than last year. The cost of the food's a little bit more money than last year. Guy who's rubbing your back as a massage is charging a little bit more. Bank of America is confirming that. And what we're seeing there is the economy's healthy. And the economy's healthy, the stock market's likely to be healthy. A little bit more on Bank of America. They delivered a standout start to 2026. They beat on diversified growth and resilient consumer activity. The jump in net interest in the meaningful improvement in the efficiency ratio highlight the management's ability to drive positive operating leverage even as they continue to invest in people and digital capabilities. Sector remains watchful of evolving risks. Bank of America's commentary on the healthy client activity and resilient American economy suggests a positive outcome for the remainder of the year. 2026 forecast is supported by a stable credit environment and strong momentum in high growth segments like global markets, positioning the bank to capitalize on a favorable macroeconomic backdrop. When a big bank like Bank of America and Goldman Sachs and Morgan Stanley, when they say things are going well, it's one of the flags you have to check during earnings season. Another one you have to check is how are the big tech companies doing, especially the ones that are tied towards the important artificial intelligence trade. ASM Lithography, they blew away their numbers in the first quarter. The Dutch maker of lithography machines used in making semiconductors also hiked its 2026 guidance. It's had a record climb, as has KLA Corp and Applied Materials. The scramble to build more chip-making capacity is a boon to these semicap names. They beat on expectations. They raised their guidance and also spoke constructively about the longer-term outlook for semiconductor growth, saying it continues to solidify as AI infrastructure investment ramps. Additionally, as customers continue to add capacity amid ongoing supply constraints, demand for advanced lithography continues to build, reinforced by commentary around strong orders and ASM Lithography's own capacity expansion plans. Despite that, shares are trading lower, which appears to be mostly to reflect the softer second quarter guidance. ASM also reaffirmed its margin outlook despite the higher revenue guide, noting that the ramp-related costs such as hiring and training are offsetting some of the near-term benefits. The conference call and the report did little to disrupt the longer-term story, but the downside on second quarter guidance appears to be prompting some investors to take a little bit off the table. Let me pull up the chart of ASML. Back in 2025, at the start of the year, I called this one of my favorite stocks to add to your portfolio. Back then, it was a $600 stock. Today, it's a $1,400 stock, more than doubling. It is starting to look... Their dividend is about 0.5%. That's not bad. The PE ratio is a little on the high side. Stock's near an all-time high. It's trading at 25 times next year's earnings, which isn't the greatest. But it does have the growth to stay in that neighborhood, if that makes sense. I don't think it can hold 35 times earnings. It is an equipment play that takes a long time to deliver goods. Some other stories that are out there today. Jeep, the Ram truck maker, Stellantis is rising on improving first quarter sales. 7-year car loans are gaining in popularity. I did that story yesterday. That's unfortunate. I don't think this is a close your eyes and buy the market. I would selectively add to what you need. I did that last week. And I continue to find new positions that I like that are 20% off from their all-time highs. Another tech story out there today, James Schneider is talking about Broadcom Meta AI partnership expanding the multi-gigawatt roadmap, reinforcing AI infrastructure leadership. Yesterday, Broadcom announced a multi-year, multi-generation strategic partnership with Meta to support Meta's MTIA custom compute chips. Broadcom is delivering its networking solutions to address Meta's scale-up, scale-out, and scale-across requirements as part of the partnership. Broadcom CEO Hock Tan is transitioning off of Meta's board of directors and into an advisor role for Meta, where he's expected to provide guidance on Meta's custom silicon roadmap. This announcement further reinforces the importance of Broadcom's role in the ongoing AI infrastructure build-out through its industry-leading XPU platform and its networking capabilities, and multi-year strategic partnerships with leading U.S. hyperscalers, providing visibility into the company's long-term AI revenue growth. $480 price target according to Goldman Sachs on Broadcom. Ticker symbol it's a weird one. It's AVGO. And why do I say it's weird? Because it doesn't have Broadcom in it. So there was a company called Avantgo who bought Broadcom essentially. It was a merger, but I think it really was going towards, it was their idea. So they kept the old ticker. Broadcom's a $393 stock. Just to show you how inefficient the markets have been. Last week, you could have got the stock for $315. Now it's at $392, up 3.2% today. Remember that analyst number where he said he expects it to go to 480, which is about 90 points higher than it is now. Morgan Stanley turned in a great quarter, seeing shares up 2%, massive beats on equities and fixed income. Again, when banks do well, it's really a good sign for the economy. I used to say, and I don't really say it as much, but you almost have to have a healthy banking sector to have a healthy economy. They lend money. That's the lifeblood. Money is the lifeblood of business. Unless you're in beauty, and then beauty is your business. Bank of America analysts cut their Wells Fargo price target and removed it from their best ideas list. That's unfortunate. They reported good, but not a good enough quarterly numbers. The bank also detailed its private credit portfolio, including $36 billion in corporate debt financing with 17% software exposure. That could get hurt ultimately by Anthropic. Johnson & Johnson got some price hikes today. Barclays went to 255 from 234. Stifel went from 220 to 250. Growth is picking up thanks to its strong pharmaceutical portfolio led by cancer and Tremfya. Johnson & Johnson is shedding its slower-growing orthopedics unit. When a company sheds slower-growing units, Wall Street loves it. Cost of doing business is labor, and when you're shedding a unit, you're also shedding labor. Johnson & Johnson's a nice name for a long-term patient add to your portfolio, especially when it's out of favor. The more you listen to this show, the more you learn. I like things that are out of favor. When you take a look at the all-time chart on this, when I started investing in 1995, it was a $5 stock. Today, it's a $238 stock. That's amazing. Now, that's my 30-year career. But if we were to say, let's take a look since 2015, it's gone from 106 to 238 with a 2.2% dividend yield in there. Again, amazing. All time, if you go back to when it first started trading back in 1987, it was a $2 stock, and now it's a $238 stock. That's generation wealth. That's game-changing for families who invested and stayed in the company. You can buy boring. You got to be a little bit careful on buying boring, but you can absolutely buy boring. Baird is up in its price target. And if you buy boring, buy it for the long term. Don't get disappointed. Johnson & Johnson had a big gap up. I probably wouldn't buy it today. Unless I was going to own it for 30 years and buy it next year and the year after and reinvest that dividend. Check that box. Baird up its price target on CVS to $94 from $92. It reiterated its buy rating. CVS is important, in large part because Walgreens is struggling. Rite Aid's gone. CEO David Joyner changed the narrative and laid out a path for mid-teens earnings growth. CVS is essentially the last man standing in retail drugstores. It also has an insurer, Aetna, and pharmacy benefit manager Caremark to go with it. In the end, is it a stock that I own? I don't, but the CEO is doing a great job. Now, luxury stocks have been pretty good, except for the fact that now they're not acting pretty good. They're very selective now. But Gucci parent Kering and Hermes, both luxury stocks, getting clobbered. Very dependent on the Middle East wealth. It's intense how luxury needs the Middle East. And the Middle East is a mess right now. Cloudflare got an upgrade at Piper Sandler to buy from hold, $222 price target. Stock closed yesterday around 178. Website security and speed is changing to edge distribution, which is terrific. Cloudflare has servers around the world at the edge or close to where users are located to boost speed while also acting like a centralized cloud. I'm going to talk a little bit about Jamie Dimon and what he had to say about getting his hands on the new Anthropic model. But I'll get to that maybe in the last segment today. Second segment is going to be Patrick O'Hare. Microsoft's price target was lowered to $500 from $540 at Baird. I expect Microsoft to report solid earnings in the coming weeks. We got to get a better AI strategy being communicated from Microsoft to the world. In the last 2 years since you first met AI, what's your tendency been? First, I think we all got fascinated with OpenAI, ChatGPT. Then we learned, it hallucinates a bit too much. We saw them do crazy stuffs like Sora and add purchasing from searches into their models. They've added advertising. I've migrated to the better model in the United States, Anthropic's Claude. I don't mind paying for that one. Microsoft's target being lowered is just, again, we've seen 2 or 3 of these in the last 2 or 3 days. Wall Street's saying, we don't think that Copilot's doing everything it needs to be. My choices are Gemini and or Claude. It's never, I should see what Copilot creates. My kid had to put together a soccer film footage for college coaches. And so easy to do. And creating graphics with Gemini. You have to like a card, 6'4", 185 pounds, 3.5 GPA. You had to put like a card together of yourself. So easy with Gemini, and it looks so good. They even went and got the school logo. It looks like a legit, trading card. Netflix is going to report tonight. Analyst Matthew Condon at Citizen says, we expect Netflix to report better than expected first quarter 2026 results with potential upside to 2026 earnings per share driven primarily by recent U.S. price increases. Stepping back, he's convinced regarding Netflix long-term structural advantages, most notably in unmatched scale and global distribution, which underpinned its ability to sustainably raise prices while continuing to outspend competitors on content. Shares have re-rated following both the decision to walk away from the Warner Brothers Discovery acquisition and the announcement of the U.S. price increase. They're now trading close to their 5-year historical average PE and EBITDA multiples, enterprise value to EBITDA. So Citizen's saying we're waiting for a more attractive entry point before becoming more constructive on the shares. So the valuation keeps them a little stressed. I don't mind that. I think that's healthy. When an analyst says, wait for a pullback, and we had a pullback. If you remember, it was in the mid-80s a couple weeks ago. People were fearful they were going to acquire Warner Brothers Discovery. I was saying at the time, best thing in the world that would happen to them if they didn't. Hey, coming up in the back half of the show, I've got big news on Amazon, on drug discovery with Amazon, on Tesla's AI pivot, and the concerns on the Terafab. I've got more show for you, but coming up, we got Patrick O'Hare with Briefing.com. Last chance for a big push. I've got a Pints and Portfolio coming up this weekend, 11:30 to 2 in Sunnyvale, California. It's a good chance to meet with me. Ask me about what I've been buying. I'll tell you. I'll ask you what you've been buying. You show me yours, and I'll show you mine. I love that game. On top of it, I'll bring a couple CFPs. We'll talk about where you are in financial planning, if you're going to have enough, if you're going to have to move to Tonga or Bora Bora to save on cost of living. You can find more out about this event. Again, it's this weekend. I'll buy the beers. You just show up in Sunnyvale, 11:30 to 2. I'm Rob Black. Sign up at robblackshow.com. robblackshow.com. That's robblackshow.com under events.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Welcome back in. The Rob Black Show. Rob Black and Your Money, whatever it's called these days. Joining me now from briefing.com, Patrick O'Hare. He's always been how I start my day on Wall Street with his page one column at briefing.com. Plus, there's economic calendars. When you do a financial media show, it's a great site. If you invest, it's a great site because there's a lot to draw upon, not just Patrick. Mr. O'Hare, though, we need you today. NASDAQ's been up 10 days in a row. Did you see that coming?
Good morning, Rob.
Hey.
No, I can't say that I would have thought that we'd see a 10-day win streak, but we did sense that we would see some type of rebound effort and wrote as much a few weeks ago. I think we've talked in the past about some of the red lines that briefing.com identified for when the president might look to take some type of off-ramp that would appease the market and market sentiment. And we pretty much got through or right at those red lines. Oil, $100 a barrel, national gas prices averaging $4, an S&P 500 that was at a correction mode, so down in the 6,300 area, and a 10-year note yield that was at 4.5%. We didn't quite get there to 4.5%, but we were moving there. And so all of those things gelled, and sure enough, we saw the president back off from the threat to bomb Iran's power and energy infrastructure. And so the stock market found some great relief in that because they saw it really as the exercising of the Trump put once again. And we've seen a massive short covering rally, but also some chasing action here, likely predicated on the belief that we could see something akin to what we saw after the president backed off his Liberation Day tariff announcements last year.
So we are in earnings season. I will assume that we could say the Iran war will eventually wrap up, but it's going to be a different situation than it was before, and it's going to bring up a lot of questions. But moving on to earnings season, the banks, the big banks, the Goldman Sachs, the Morgan Stanleys, the Bank of America, the Wells Fargos, they're the first to report. And from what I'm looking at from a distance, because I don't really follow banks, it looks pretty good. What are you seeing?
Your, a far-sighted vision? It's pretty good, Rob, because the results themselves have been good and not entirely surprising. The financial sector was expected to be the second biggest contributor to earnings growth in the first quarter. And what's more reassuring, I think, coming out of these reports is for the market to hear a lot of these CEOs and CFOs talk about a consumer that continues to be resilient and credit quality trends that continue to be fairly stable, and have also seen them temper the market's concerns about the private credit issue. And JP Morgan's Jamie Dimon in particular was instrumental in doing that, acknowledging that there's going to be issues, but he's not seeing anything that's likely to turn into something systemic. And that kind of helped to dial down the temperature a bit on that particular issue. And so, yes, it's a good start here, and we'll get rolling really with the bulk of the reports next week. But all eyes, once again, are going to be on those mega cap tech stocks, which have been instrumental in leading this rebound effort over the last 10 trading sessions.
You mentioned Jamie Dimon giving private credit off, so to speak, saying it's not as bad as we're assuming. But I think it was about 90 days ago, he said where you see one cockroach, there's multiple and then Wall Street financial media machine just talks about it nonstop, cockroaches. I don't know sometimes I love Jamie Dimon. Sometimes I go, hey, I think he's a little self-interested. But I'm digressing. Let's talk about those big tech companies. They have been having an amazing rally, like I said, 10 days in a row on the NASDAQ, and their earnings expectations are high. It's coming back in favor. It's almost as if the oil trade stole from the small cap trade at the start of the year, the broadening of the market trade, turned into the oil trade. Now the oil trade's turning back into the AI trade, which was fantastic for 2.5 years until about last October in 2025. Is that healthy rotation? Is it rotation? Or what do you make of this swing back into AI?
Well, I think it's an understandable rotation given what's going on in the macro backdrop right now. This is a time where probably behooves one to favor quality names, and I think there's still a reasonable belief that these mega cap stocks are the ones that are going to be able to forge through any type of economic slowdown in the near term better than other companies, and they certainly were subject to rotational interest as the year unfolded. And so it's not entirely surprising here. A lot of them got oversold on a short-term basis. And now, it's like kind of the broader market there. You have to see if there's going to be follow-through here. We're back, pretty much near record highs. And I think what we get out of the earnings period will help us determine if we're going to, break out here or stall and maybe roll over a bit. But it's healthy at the index level. I'd have to say that these large cap tech stocks are back in action because they have such a heavy weight in the index. And not to sound trite about it, but with an index fund, it all counts. It doesn't matter how you get it. It's just whatever the leadership is, it's going to translate into more money for the investor. Ideally, yes, you want to see broad-based participation, and we have seen that. It's just that we've had relative outperformance here by the mega cap stocks in this month of April. I'd point to the Vanguard Mega Cap Growth ETF as a proxy for that group. It's up just over 10% for the month versus about a 4% increase for the equal-weighted S&P 500. So most stocks are up, but those stocks are clearly leading.
I just saw on briefing.com in the in play section, which kind of breaks news, whether it be research, economic data, Fed speeches. In this case, it broke news that the U.S. government is looking to potentially meet with Iran. And what I liked about that, and I'm giving a plug right now to briefing because I don't have the ability to be at the Wall Street Journal, to be talking with you, to be doing financial media, but Iran and U.S. may be agreeing to sit down one more time this week. So it's interesting times, to say the least. What else are you seeing in today's in play, or not in play, but in your column, page 1?
It is just amazing how quickly market sentiment can turn here. And the title of my page 1 column this morning was that you moved from a 10% correction to a 10% rebound in 10 days. So,
I'm stealing that.
Yeah, it's, again, as I alluded to earlier, quite a bit of short covering activity was helping in that effort, but you've seen bullish sentiment reengaged here because of the expectation that this war is soon to end and that you can hopefully get some normal traffic going through the Strait of Hormuz, which then promotes the belief that you'll have better supply of oil in the future and help get energy costs down. And so a lot's still hanging around these negotiations, but I think there's been enough chatter from the president to suggest that the preferred outcome is to see this come to an end. The market is certainly acting that way, and it's effectively embracing this view that while this has been disruptive in the short term, that the global economic fallout isn't going to be extreme over the mid to long term. And so therefore it can see through this disruption, and that's why we've been able to trade back up to these record high levels. And most importantly, the earnings estimate trend continues to be quite positive. We've seen that forward 12-month estimate for the S&P 500 increase from $317 at the start of the war to $334 today, all while prices were coming down. They've now rebounded, of course, but you've seen multiple compressions. So you have a market that, is looking at somewhat lower valuations than we saw when the war began, but just as strong, if not stronger, earnings growth than was expected at the start of that war. So if we get the earnings news coming through along with some decent guidance, then we should see a market that's showing some resilience here.
So I always give you the last softball and say, what are you working on, or what do you think we need to know? Because I monopolized the first 8 minutes or so. So your turn for 2 or 3 minutes of what's on Patrick's mind.
Sure. One of the things that we need to keep watching, I think, from a macro standpoint, what's going on with real earnings, and because that's going to be the driver of discretionary consumer spending activity. And what we saw out of that March employment report, coupled with the March CPI report, showed that real earnings are basically flat year over year. And that's going to be an important trend. If that continues to moderate or dips into negative territory, then it would suggest that consumers, if they're going to retain their current spending activity, are going to have to dip into savings or perhaps use credit more as a means for buying the things they need as opposed to what they want. And that can have a broader impact on the overall economic outlook. But again, it's going to come back around, though, to if the market can see this as more of a short-term disruption versus a long-term issue. And we'll just need more data to reinforce that view. But obviously for now, the market's content based on what we're hearing out of the banks that the consumer's holding up. And the data does continue to suggest the consumer's holding up, which is why the state of the labor market is going to be really important here as we move ahead through the year.
Yeah, we got to keep a short-term memory. We got to keep activating that one so that it doesn't go away, because the labor market is what drives the economy. The economy is what drives the stock market, and the labor market has been weakening, according to data that I consume from briefing.com. Thanks very much. It's Patrick O'Hare, a reliable source of domestic and international news you could use. I love his calming approach. It doesn't ever seem to get emotional. It doesn't get greedy or fearful or anxious. I think that's super important. Being in the industry 25 plus years, calm is the approach that we should all have. That's Patrick O'Hare with briefing.com. I'm Rob Black. You can find me online at robblackshow.com.
This interview featured on The Rob Black Show is brought to you by EP Wealth. Learn more at robblack.com.
I do like Patrick O'Hare. Thanks for listening to the show. Thanks for coming to events like Pints and Portfolio and seminars. I always make sure that they're free, and I always make sure that they have a lot of information with no hard sales pitches at all. With that said, come to one. I'd love to see you. I'm getting up there in work years, and when I'm done, I'm going to be done. I'll still answer emails, and I might still do like one podcast a week. But sometime in the next 5 years, and I've said this for the last year or two, it could be this year. I don't know. I'm not working for money. I'm working to show my kids what work is at this point in time. I'm working to share some knowledge. I hope you get something out of this. Brent crude up 56% for the year. The silver up 12%, gold up 12%. Those numbers have come down rapidly. As central banks was buying gold at all-time highs, now central banks are selling gold. Bitcoin's still down 16% for the year. The Morgan Stanley All-World Country Index up 3.9% for the year. Not bad. If you were to say, through 1/3 of the year, up 4%, if we can get, up 4% and up 4% again, that'd be a great year. Looking for anything over 10% is adding a lot of risk to your portfolio. The Magnificent 7 ETF is down 2.66 year to date. The Russell 2000 is up 7.8%. The Nasdaq's up 1.7%. The S&P 500 up 1.5%. The Dow Jones Industrial Average up 1/3%. NVIDIA is impressive. I know the Nasdaq's had 10 winning days. Part of that is NVIDIA has had 10 winning days in a row. A 19% run from its March 30th lows. Big, huge, ginormous rallies like this don't happen often. For NVIDIA, it's only happened twice since 2016. The first occurrence, obviously, was 2016. It traded flat for about 3 months after its winning streak ended, before surging 80% over the next 12 months. So if you believe in history, NVIDIA is about to have a big charge higher, and they could do it based on valuation. I'm not saying they will do it. So we haven't seen the hyperscaler CapEx come down yet. It still continues to climb, but more competitors are in there, like Broadcom. Blackwell demand continues to outrun production, though. Earnings estimates have barely moved while the stock has rallied. There was talks yesterday that they're actually thinking about buying a computer maker like a Dell or an HP and reshaping that world, instead of letting Dell and HP, figure out the Intel chips or the AMD chips or the NVIDIA chips. when you're that big, you could use your market cap to acquire companies. And that 10 day in a row thing I was just talking about, it's set itself up now for some sort of run. Now, it's got a $4.7 trillion market cap is the only reason it shouldn't have an astronomical run. But most analysts I see talking about NVIDIA are talking about it higher, considerably higher, to the $250 range, some as high as $300+. It's currently at $199, up 1.7% for the day. This was a stock that I picked up along with Broadcom last week and a couple others. I tell you so that I can be, what is the phrase, transparent. I didn't think Trump was going to go through with his "I'm going to destroy their civilization" threat. For a guy who is angling for a Nobel Peace Prize, it seemed too dramatic of a switch, although not terribly unexpected from this administration, as it's been slightly random at times. Is that a nice way of saying that? Let's talk Amazon. Loop Capital's Rob Sanderson said there's been a lot of news circulating on Amazon over the last 2 weeks. The Globalstar acquisition was confirmed. We think the satellite broadband investment has been an indirect overhang as it drags on its retail segment margin. The upcoming change to capitalizing most expenses will remove this. The upcoming SpaceX IPO will shine a more favorable light on Amazon's satellite broadband ambitions. The OpenAI CRO had encouraging commentary, the chief revenue officer, about inbound demand for ChatGPT on Amazon Bedrock. Last week's CEO letter had several new point disclosures, including on revenue contribution from AI chips and AI services. This reinforces the view that Amazon Web Services revenue will likely continue to accelerate as capacity becomes serviceable. Amazon Web Services is the most important driver of Amazon shares and represents over 60% of the valuation. He reiterates a buy ahead of results on April 30th, about 15 days from now. Loop Capital is actually one of the more bullish firms on Amazon, raising the price target at $360. The previous target they had was $300. The consensus on the street is at $287. So they are definitely in the bull camp. Now remember that $360 number. The current price on Amazon is $248. That's a pretty big jump. Very bullish. $360, and it's currently at $248. If you own the S&P 500, you own Amazon, so don't feel like I'm putting pressure on you to go buy it. I own shares of Amazon. There's another Amazon story out there today, and this one's even more fascinating to me. Twist Biosciences, ticker symbol TWST, seen as a beneficiary as Amazon launches AI drug discovery platform. Anas Subunabi noted that Amazon launched Amazon Biodiscovery, which is an AI-powered application to support antibody drug discovery and design. Notably, the platform partners with Twist and DNA, ticker symbol DNA, as integrated wet labs to synthesize and test lead candidates. Data generated in the wet lab is then fed back into the model for additional training and drug candidate refinement. If you were to ask me to explain this to a group of teenagers, I probably couldn't. Twist, if this was captured in guidance already, said they noted that it's brand new, just launched today. They're watching it closely. Checks do not indicate as much conviction in superior commercial drugs coming from such a platform. The analysts at Guggenheim view this still as a benefit to screening companies like Twist. Tesla's AI pivot is a big one. It's driving long-term upside, but trillion-dollar terafab capex clouds near-term sentiment, according to Barclays. Dan Levy highlighted on Tesla's fourth quarter results, we highlighted that the end of the Model S and X production marked a symbolic baton pass for Tesla from automotive to physical AI. With autonomy, robotaxis, and full self-driving, and bots to be Tesla's core growth focus for the years to come. Last month, we saw the next big step of that transition as Tesla unveiled its plans on Terafab, reflecting an ultra-aspirational plan to build 1 terawatt fab, which would be 50 times current global industry AI compute. So that is an aggressive push that has me saying no way. It would also represent an even deeper level of vertical integration for Tesla. Alongside Terafab, Tesla is also planning to build 100 gigawatts of solar capacity, with initial steps seemingly taken on this. These developments are reminders of the exciting growth opportunities ahead for Tesla, further strengthening the meme element of the stock. However, into the current quarter, alongside the question of how Tesla will execute on Terafab and solar build-out, is a key question is, how much incremental capex Tesla will need to incur for these projects, especially for Terafab, which could cost it in the mid-single-digit trillions. That's 2 to 3 to 4 to 5 trillion. We don't expect Tesla capex to exponentially increase. We nevertheless expect a further step in capex from the elevated $20 billion figure Tesla talked about on the last call. Tesla's numbers are very small on capex, and they got to get way bigger if you're going to build a Terafab that would outcompute the rest of the whole world fabs. As for Tesla stock, it's been weak, and this again, according to Barclays, year to date, it's down 19% versus the S&P 500 up 2%. The weakness reflects seemingly little progress disclosed on robotaxi, full self-driving, and Optimus. We believe the year-to-date weakness could imply on the surface an opportunity for the stock to outperform on results. However, we take a more tempered view into the print as commentary of incremental capex could be perceived negatively. Amazon is buying satellite company Globalstar for $11.6 billion. I talked about that yesterday, but that's in Amazon's news today because it's going to change how they spend money and how it's accounted for in the financials. Ted Sarandos from Netflix has reportedly met with theater owners at CinemaCon this week as the streaming giant mulls putting more of its movies in cinemas. Elon Musk's AI bot Grok is still generating sexualized deepfakes of people without their consent. Jamie Dimon says Anthropic's Mythos reveals a lot more vulnerabilities for cyber attacks. I always love hearing him talk, and sometimes I'm starting to hate it. You'll hear about that, or you heard about that when I was talking with Patrick O'Hare. 90 days ago, he's down on private credit. Now he's like, it's not so bad. JP Morgan Chase CEO said yesterday that while artificial intelligence tools could eventually help companies defend themselves from cyber attacks, at first they're going to make them more vulnerable. JP Morgan was testing Anthropic's latest model, the Mythos preview, announced by the AI firm last week, as part of its broader effort to reap the benefits of AI while protecting against bad actors wielding the same technology. He says AI has made it worse. It's made it harder. It does create additional vulnerabilities and maybe down the road, better ways to strengthen yourself too. When asked by a reporter about Mythos, Dimon seemed to refer to Anthropic's warning that the model had already found thousands of vulnerabilities in corporate software. Dimon said, I think your read is exactly what it is. It shows a lot more vulnerabilities. The remarks reveal how artificial intelligence technology welcomed by corporations as a productivity boom has also morphed into a serious threat. Now, JP Morgan has spent billions investing to stay ahead of threats. They spend a lot of money. They've got top experts. They're in constant contact with government. Cybersecurity is a full-time job. Goldman Sachs CEO David Solomon also said during an earnings call that his bank was testing Mythos, though he declined to comment further. About 60% of U.S. farmers say their finances are getting worse as fertilizer, fuel, and costs rise. That's probably going to mean higher food costs in the future for you and me. Fertilizer prices have surged due to shipping disruptions from the war in the Middle East, and the higher costs are rippling across U.S. agriculture just as spring planting gets underway. Farmers are being forced to scale back inputs, shift crops, and reconsider how much to plant. This could affect the supply of certain crops in the U.S. around the world. Almost 6 in 10, or 58%, of farmers are reporting worsening financial conditions amidst rising input and fuel costs. I think the war's over. Fertilizer nitrogen costs on farms have jumped from $139 per acre to an unexpected $217 an acre this season. It's going to hit farmers' bottom line. It's also going to hit their ability to grow the quantity of key crops that they usually would. I'm going to take a break. I'll come back for the afternoon podcast. You can hear me online at robblackshow.com. That's robblackshow.com. Don't forget to sign up for the seminar.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.